When the consumer price index, ex-food and energy, rose to 0.8% back in November, some wondered if we had seen the bottom of core inflation. Well, our next guest says we have. David Greenlaw is the chief fixed income economist at Morgan Stanley. He is also a Bloomberg best overall economic forecaster. David joins us now from his firm in New York. David, happy New Year, and thanks for joining us here on the show.
Same to you, Lisa. Pleasure to be here. So
a lot of people now asking this question about is inflation, and people, of course, watching for these Fed minutes that will come out to see if there's any consideration or nod to the notion that inflation could be increasing. You and your fellow economists say yes at Morgan Stanley.
Yeah, I don't think it's anything to really panic about on the near-term horizon. I think obviously there's plenty of slack in the economy. The unemployment rate remains quite elevated. But I do think that the uptick that we saw in the November CPI data does represent an important turning point, and we're going to see a bit further escalation in core inflation going forward from here. And it's largely a shelter story. Shelter is more than 40% of the core CPI. It's closely tied to rental market conditions, and rental market conditions are improving significantly at this point, and I think that means some upward pressure on core CPI.
You know, that is a surprise. I don't know that a lot of people realize that off the top of their heads, that 40% of the CPI is driven by this category called shelter. That includes, when you talk about the rental market, is that exclusively residential rents?
Well, there's three major components of shelter. Owner's equivalent rent, which is kind of notorious in attracting some interest. That is an attempt to measure what you would pay to rent your own home, but they do it based on a survey of actual rental market conditions. Then there's a smaller component, residential rent, which is just a survey of apartment buildings and what they're charging for rent. And then the third category is still smaller, and that's hotels. But within that broad shelter grouping, rental market conditions are really the main driver. And you can look at vacancy rates, which are coming down pretty significantly across the country. You can look at industry data, which survey effective rents, which show definitely some upward tilt over the course of the last 6 to 9 months. But the stat that I think drives it home the best is that there are about 8 large apartment REIT companies, and there's an index of those companies. That index was up more than 40% in 2010, an indication of some significant improvement in the fundamentals for the apartment sector.
Let me ask you this, as it relates to the total U.S. economic picture, if we're starting to see this improvement in the rental market, does that mean that we're not going to see an improvement in home prices?
Well, I think the two are separate. One of the things that obviously is driving some improvement in the rental market is a declining home ownership declining home ownership rate. So the home ownership rate peaked out a little bit above 69% during the boom period. It's now at about 67%, probably on its way to a sustainable pace of maybe 65%. So you're seeing lower home ownership, which means more demand for apartments. You're also seeing a pickup in household formations. So during a recession, you typically have a slowdown in household formations as families stick together to some extent. You continue to live in the parents' basement for a while if you can't get a job coming out of college. As the economy improves, household formations begin to improve. So you've got, on the demand side of the equation, more renters because the home ownership rate is going down, and you've got more renters because the household formation rate is going up. It doesn't tell you a whole lot about the housing market. I think the housing market is troughing along at a bottom, and it will probably continue to do so for the next couple of years, burdened by this large inventory of homes for sale and an even larger shadow inventory of homes that loom behind the scenes.
All right, David, let's talk about another key component of an economic recovery, and that's employment. We have an important number coming out this Friday. I mean, are we entering a stagflationary period of time if we don't see some improvement in that number?
Well, I think we're a long ways from seeing any sort of significant stagflation problem, because the uptick that we're talking about on the inflation side is pretty modest, and it's from a very, very depressed level. On the employment side, I think we are seeing some indications of improvement. Last week's jobless claims number was just the latest in a string of indicators that point to some pickup in labor demand. And I think basically what we're seeing is a normal cyclical slowdown in productivity growth, which means that if the demand side of the economy economy is sustained, and I think indications you're seeing from today's car sales report, indications from the chain store sales numbers over the holidays, the demand side of the economy is sustaining itself at this point. If that's the case, companies are going to have to add some labor to begin to meet that demand as long as productivity growth continues to moderate. And so we're right at the cusp of a normal cyclical turn where companies will start to add some labor. So we've got an estimate for Friday of 160,000 for payrolls. I think that's pretty much in line with the consensus, but it is most importantly, I think, part of an improving trend that will continue for months going forward.
Where do you see the unemployment rate, David, as part of that?
Ticking down a tenth to 9.7. I think we may have seen the peak in the unemployment rate. That is subject to some monthly fluctuations that could lead to a little bit of elevation going forward at some point. But I think we've probably seen a peak in the unemployment rate, and we'll be down around 8.5, 8.75 by the end of 2011.
David, you spent some time at the Federal Reserve. A lot of people are talking about Bernanke. Obviously, we get the FOMC minutes today, and then Bernanke also testifying before Congress this week. What do you expect, or what do you imagine is going on at the Federal Reserve now? What do you think they think about the economy?
Well, I think they've got to be impressed by some of the incoming data, which points to improved momentum. I think the Fed has been worried about the pace of the recovery, and I think the recent data probably allays their fears somewhat. I think in the minutes today at 2 o'clock, we're unlikely to see much indication of that because these are minutes from December, the December 14th session, and the statement that they released after that meeting was noteworthy only from the standpoint of probably containing fewer wording changes than any statement in history. So I think we'll get a similarly kind of blah set of minutes from the Fed today. But you've had some fiscal stimulus enacted since that meeting. You've had some relatively impressive data since that meeting. So I think Bernanke on Friday could upgrade the Fed's assessment of the economic outlook and, set the tone for the next FOMC meeting, which I think they'll begin to discuss winding down the asset purchase program. I think they'll continue to do the $600 billion of purchases through mid-year, but I think they'll wrap it up at that point, and that's the end of that's the last we'll see of Fed asset purchases going forward.
And David, very quickly, we've got about 10 seconds here. Where do you see monetary policy going? Will there be a change? Could we actually see the Fed decide to pull up its key rate?
Sure. I think we won't see rate hikes in 2011. I think we'll see rate hikes starting relatively early in 2012.